Hello, I'm Tony Marino, CEO of Tenaz Energy. Thank you for joining us for our 2023 mid-year update. Before we get started, please note our advisory on forward-looking statements. Let's start with a review of our operating and financial results. Let's look at our first half 23 highlights. For the first half, we averaged 2,119 BOED. That was about 2x our year earlier production. That was driven by our first Netherlands acquisition and continued organic growth in Leduc Woodbend in Canada. Funds flow from operations, or FFO, for the first half of 23 was $10.6 million, more than 2x higher than what we had in the first half of 2022. Free cash flow was positive by $4 million in the first half of 23, compared to negative FCF of $1.1 million in the first half of 22. We retired 715,600 shares through our NCIB in the first half of 23. That's 2.5% of the float, bringing our total retirement of shares since we started the NCIB to 4.3% of our total shares. Average cost, $2.25 per share to date. And the final point on this slide, in the first half of 23, we were able to have approximately the same netback that we had in the year earlier period, or in the first half of 22. This is despite the first half of 23 being a much lower overall commodity environment than in 22. The reason we could maintain the netback is that we changed our product mix. We brought in a significant share of very high netback, very high priced and very high netback European gas, and that allowed us to keep our netback where it was despite having lower commodity prices in Canada and in general a lower commodity price environment in the world as a whole. Drilling down into Q2 2023, in June we announced the acquisition of XTO Netherlands, increasing our ownership in the upstream and midstream assets in the Dutch North Sea, and I'll talk about that more in just a minute. Production volumes averaged 1,903 BOED in Q2 23. That's 19% lower than we had in Q1. This decrease was driven by scheduled facility maintenance that we had in both Canada and Netherlands. We started our 2023 development program at Leduc Woodbend in Canada, drilling the first 2 out of a 4 gross well program during June. The remaining drilling is underway, as will be the completions of those wells during Q3, and they'll be on for Q4 of this year. At the end of the quarter, we had adjusted net working capital, or negative net debt, of $17.1 million. This is before the addition of another $46.7 million in positive net working capital as a result of the XTO acquisition that we closed in July. We commissioned an independent resource report by McDaniel to describe the resource potential on our Netherlands asset. That report was completed and shows a after-tax NPV for the best estimate contingent resource of $86 million. I'll cover this and the prospective volumes as well a little bit later in this presentation. XTO acquisition is a follow-up to an earlier deal that we announced at the end of 2022, acquiring non-operated upstream and midstream interests in the Dutch North Sea. This transaction adds 450 to 500 BOED of productive capacity, all TTF natural gas, and comes close but doesn't quite double our ownership interest in most of the upstream blocks that we already had an interest in. It also increases our interest in the NGT pipeline system for offshore gas gathering to 21.4%, making us the second largest owner in this very high reliability system. The operating and financial results for XTO were not included in our Q2 results. Having closed that transaction early in July, XTO will count toward our production and cash flow beginning with our Q3 release. I'll point out that June 2023 production was about 475 BOED for this set of XTO assets, and our overall Netherlands production was about 1,250 BOED. In addition to the upstream and midstream assets, we received positive adjusted net working capital of $46.7 million in this transaction, and we acquired independently evaluated reserves by McDaniel of 0.7 million BOE, almost entirely natural gas, with an ATAX NPV 10 of $7 million. That is net of the abandonment cost. Let's discuss the resource report for our offshore Netherlands assets. These resources are potentially recoverable volumes that go above and beyond the reserve report that we last issued at year-end 22. For the resources, it'll include both the private company that we had in our portfolio at the end of 22, plus the additional interest that we acquired from XTO and closed in July of this year. There are two categories of resources: contingent and prospective resources. I'll start off by discussing the contingent resources. These contingent volumes are the estimated recoverable oil and gas from discoveries that have already been made. So in other words, pools that have been drilled into and already tested. In the case of our offshore Netherlands assets, there are 4 pools that are included in this category. 2 of them are oil pools. Map for these are shown in the lower left-hand part of the slide. These are in the northern part of our asset base offshore. They are operated by Wintersal. We have a 5% interest in these 2 oil discoveries named Rembrandt and Vermeer. There are also 2 gas pools that have been drilled into and tested by in the southern part of our asset base, the shallower water part of the asset base, and these are operated by Neptune. We have a 21.4% interest in these 2 gas pools. McDaniel does a range of estimates for the recoverable volumes from these discovered but undeveloped pools. The low-end estimate is 2.4 million barrels equivalent, again, for the combination of the 4 pools. High-end estimate of 6.9 million barrels equivalent, and the midpoint, or the best estimate, is 4.3 million barrels equivalent. There is also a risked mean estimate. This is the statistical mean of that distribution of potentially recoverable volumes, and that number is 4.5 million barrels equivalent. Again, net to Tenaz for the combination of the 4 pools, 2 oil and 2 gas. We also asked McDaniel to create an economic case for the best estimate volume, 4.3 million barrels equivalent, based on estimated capital cost to develop the 4 pools, and using the 3 consultant average oil and gas price decks that are currently in place. And that estimated after-tax net present value discounted at 10% was $86 million. Again, we only had an economic case created for the midpoint or the best estimate. There's another category of potentially recoverable volumes. This is called prospective resource, and these are really exploration prospects. These are pools that that haven't been discovered. They may or may not be there if drilled. There's quite a range of prospects, a total of 21, 4 oil, 17 gas prospects, really throughout the undeveloped offshore leasehold that we have. In terms of unrisked potential recoveries in aggregate, were these pools to be drilled and discovered, net to the Tenaz interest, the range at the low end is approximately 9 million barrels equivalent, 48.5 million barrels equivalent on the high estimate, and the best estimate for the unrisked volumes net to Tenaz would be 19.8 million barrels equivalent. Again, you can create a statistical mean to this distribution, and then applying the chance factors of discovery, were they to be drilled, the volume net to Tenaz would be a little bit over 10 million barrels equivalent. So this represents, again, the contingent and prospective resource as independently evaluated by McDaniel on our offshore asset base. So finally, let's talk about our record of growth and our outlook for the company. First of all, the 23 outlook. The development program that we're operating for this year is a 4 gross 3.35 net well program in our semi-conventional oil development project at Leduc Woodbend in Alberta. As I talked about earlier, those wells are in progress now, and they should be on production by the beginning of Q4. At the time we announced XTO, we revised our production guidance to reflect that acquisition. We didn't make any change to our capital guidance. We do expect higher production in Q3 as we begin to count XTO, and then in Q4 as the new wells in Canada are on production, with a 2023 guidance range of 2,300 to 2,500 BOED. That production mix is shown on the pie chart on the lower left. Significant representation from very high margin European gas at TTF gas at nearly 40% of the mix. Canadian oil and NGLs making up a similar percentage of our mix, and a little bit less than 1/4 of the 6-to-1 product mix coming in the form of AECO gas. E&D CapEx estimated for the year at $20 to $24 million. We did not change that capital guidance at the time of the XTO acquisition, and we still expect to be within that range for 2023. And as I mentioned earlier, our development program is on our operated properties, and that is a 4 gross 3.35 net well program. On this slide, we want to go back to the original recap that created Tenaz Energy and just show you the progress that we've made in the company. The production shown in the lower left plot has gone up from less than 1,000 BOED at the time of the recap, or prior to the recap, up to about triple that level currently. On the lower right, we look at our funds from operations, or FFO, which is up nearly 9x since prior to the recapitalization. That's driven by this volume growth that I just talked about, and improvement in prices and margin, including bringing in that very high margin TTF gas into our product mix. While the company has grown in this time, our financial position has improved considerably. We went from prior to the recap, a net debt position to one that now, including on a pro forma basis, the net working capital that we acquire with XTO would be about a positive $65 million net working capital or negative net debt position. So a substantial increase in production, even larger increase in FFO projected under the strip in this case, and a substantial improvement in our financial position since the recapitalization. Let me close by just discussing briefly the market capitalization for Tenaz. The graph on the upper part of the slide shows our share price history this year. Current trading price for TNZ on the TSX is $3.66 per share. If you look at the table in the middle of the slide, that yields a market capitalization of about $100 million. Deducting from that our negative net debt or net working capital that we had on the books at the end of Q2, $17 million, we arrive at our EV at the end of Q2 of $82 million. We can make one further adjustment to that pro forma for the XTO acquisition. If you add in the additional positive net working capital that we acquired in that transaction, it brings our EV to $37 million, again, based on that trading price of $3.66 per share. We point out that Tenaz management directors hold 9% of the basic shares of the company. That rises to 22% on a fully diluted basis. We do feel that Tenaz management and directors and all the employees of Tenaz are very much aligned with our entire shareholder base. We're going to diligently pursue the acquisition strategy that we've outlined for the company previously. We feel we've had some success with this already, and we feel that we've got a very good acquisition pipeline. We'll be attempting to negotiate and bring in and close those additional transactions, and we certainly appreciate the support that we've had from our shareholder base in pursuing the strategy. So before we close, I'd like to point you to the investment advisories that we have at the end of the presentation. One of these is a page of footnotes that we have that apply specifically to the resource disclosure. Thank you very much for your attention and your interest in Tenaz. We look forward to talking to you again when we release our Q3 results in November.